Real estate. Welcome to the Critical Point Podcast, monthly update here in real estate relative to the NAREIT index through May. And then we'll see if we can add some other real estate indexes here to talk about. Anyway, I'm Rich Posson, and it is June 8th. All right, let's take a look at the monthly chart of the NAREIT index. You can just look online for NAREIT.com and get their data. And what I've done is overlaid cyclical behavior, not much for the top side, more of the bottom side. And I'm also going to provide a little education here on the cycle. There's at least a 9-year cycle. There's actually some smaller cycles like 3 to 4 years, but I didn't bother labeling them. But here's a 9-year business cycle. And it should look like an upside down UV when you're going bottom to bottom, or it looks like a UV when you go top to top, and in reality, there's combinations in between. Seldom is it picture perfect. At any rate, the 9-year cycle, okay, so we know how many years they bought. They bought for 5 years, going into a 6th year, and then they sold over the course of 4 years, and then they returned to buying. And if you take this and then bring in your fundamentals, economics, maybe even politics, interest rates and whatnot, you can see how it followed a narrative, it followed a bias. And so we had more demand pushing prices higher, and then less demand or even more supply pressuring prices lower. Now, the interesting thing is with this 9-year cycle, and the definition is 8 to 13 years, it also is the same as a juggler cycle that some people call 7 to 12 years, and it's just I count it a little bit different and have an extra year. We're talking the same cycle that you can find in economic data, demographics. The list just goes on. It was discovered by Juggler, and it was an economist Schumpeter's model. And it shows up in real estate as well. And Raymond Wheeler did research with climate versus real estate and a variety of others, but he showed cycles also in real estate. Okay, now the interesting thing is every other 9-year cycle is an 18-year cycle, and it should be more important. Well, look at this. Very little decline for this 9-year cycle. Sizable decline for the 18-year, but it was less than the larger 36. The 18-year was larger than this 9-year cycle. And I may have to do the math. It's fairly similar for this 9-year cycle. Might stick with that rule of thumb. So a general idea, okay? Larger the cycle, the lengthier the trend, the more important the price change or change in whatever data you're looking at. But the smaller cycles can create disruptions along the way and sometimes make for a sloppy, larger trend, and sometimes not. It's almost like they're all on the same page. Think of it different types of buyers, okay? These people bought for a few years, sold for a few years. You go into the 18-year, and these people bought for far more than they sold. Now, the interesting thing is every fourth 9-year cycle creates a 36-year cycle. And to me, the 18-year and larger cycles are super cycles. The 9-year cycle is actually a major long-term cycle. And cycles from 3 to 9 years are the long term. Anything under a 3-year, I normally assume actually occurs intra-year, and we label it entirely different. We don't give it that kind of a number in terms of the amount of time. Okay, so anyways, we see this 36 cycle drop. Well, the point is every 16th 9-year cycle should be even more serious. So why is it that we do that? It's like, every other one, we get a little more negative. Every fourth, we get even more negative. Every 8th, we get even more negative. Every 16th, it's doubling up. And we have proof it works, however, because look at this 72-year supercycle. This is the second most important supercycle tracked by the model, okay? And we find it in the stock market. We find it in the economy. And, of course, we got the big crash off the Great Recession. Market rallied into a 9-year cycle top, and this is what we were using for objectives. It was to top out the latest as of 2019, 1 year earlier than, say, the latest for the stock market and economy. And lo and behold, it did it, okay? The high in 2020 was just shy of the 2019 high, and then we get the collapse. Now, the model also shows that the market can bottom out the latest 2021, which puts it in line with the forecast for the economy and maybe even the stock market. My gut feeling the stock market's already bottomed long term. I think it's already bottomed long term for the PMIs relative to the economy, but the PMIs need to recover to above 50 to truly signal the chance for a bottom in the economy. Okay, so at any rate, the forecast says that it may have bottom. And this again, the NAREIT is REITs. It's an index of REITs, a basket of REITs that are real estate investment trusts. And the problem with this kind of investment is if it's liquid and in this index, it's going to reflect a lot of the stock market as well as real estate. So if the stock market goes crazy, at least to the downside, you're going to see the REITs get crazy to the downside. Okay, so there is an influence here where you could argue this isn't quite lining up with what we're really seeing in actual real estate, but it's a nice clue, a rule of thumb of the trend, the longer term trends of real estate, I think. Okay, so let's assume it's bottom for the 9-year cycle. The forecast then is bullish into the year 2027 for a top, which would be earlier, 1 year earlier than what I'm looking at for the stock market. And that can occur. I think there's a good chance real estate tops out a little early. Sometimes it starts up a little early. But the point is, it doesn't have to stop going up until 2031. Okay, so sometime between 2027 and 2031, real estate will top out. The economy is going to top out. The stock market is going to top out. We're going to have bear markets, and we're going to have another primary recession, meaning the most important recession that occurs about every decade. Okay. Till then, it looks like it's bullish, and you may recall I used prior objectives down in this area that I thought it would go to, and lo and behold, it finally did it. But there's no question there was a chance of being wrong. The market could have topped here, bottomed here, and then just kept going higher, but the virus recession came in and interfered. But no problem, model's still right, because it was allowing for a range of time. It was allowing for a mixture of fundamentals, the fundamentals to change from bearish to bullish, but back to bearish, as well as for the investor to change their mind. And they did it, okay? Now, what might go wrong for you using this as an indicator for real estate is it doesn't have to bottom next year. We could be looking at this nice sizable rebound here by May as no more than a knee-jerk reaction before going lower into later this year, even next year, but it should bottom out no later than next year. So how I would use this as a gauge now that you got to start thinking it's probably gone as low as it's going to go, got some kind of floor price. Now how do you convert this to regional and finally local in terms of your real estate assessment and forecasting and whether or not you want to invest in actual real estate? For those of you who are just investing in REITs, there is an opportunity to take a chance as long as they're liquid and get out of them if something goes wrong. Now, this is the S&P REIT Index. It's FRI on the symbol on my quote system, bar chart. At any rate, this is a monthly chart. And the beauty of this is we can break it down in weekly and daily and actually time some fluctuations for speculations in this and any kind of fund that links to this index. But we can also use a little more detailed information that what might be going on with the NAREIT index. Look at this move. Looks like much like the stock market. Okay, topped out about the same time, crashed, bottomed about the same time, hesitated. A little more volatility. Hesitation than in the actual stock market, however. But look at this explosive move. So for a moment, I'm calling a level 1 bottom in place, which is the most important type of swing during a year. And if you're looking for a long-term bottom, you have to have a level 1, period, okay? And quite often level 1s can be the tops or the highs and lows of the year, but there are more than one level 1 during a year, but very few. Now, ideally, what's due is this index should pull back next month, July, and for a level 1 bottom. So we're due for the most important setback during the year. And I don't know if it's going to be volatile, going to be deep. Right at the moment, it's not looking that way. I think most of the financial markets and quite possibly relative to the REITs are rather comfortable that we put a floor price in, and it's just a matter of do we have to chop around, have lengthy range trade as we wait on the economy to recover, okay? We have an indicator here given by a buy signal. So the point is this can chop around quite a bit, even if it's put in a long-term bottom, but there's still negative news coming, at least on the economy and maybe for real estate. We still could have bought a bottom in here for this index. So I will be using this more often to try to provide a little more detail of what's really going on with these indexes in REITs. Okay, so here is the Case-Shiller Home Price Index, and it's part of the S&P Dow Jones indices. I believe the S&P bottomed out or made some kind of arrangement or something. But at any rate, we can see big setback here in 2011, 2012 for this index. Oh, by the way, this is the U.S. National Home Price Index. But look how steady it's been marching up, and it really didn't pay much attention to this whole virus recession, whereas the REITs did. So therefore, we know we have a strong connection to the stock market and REITs, and it's likely because it's such a liquid market that people can jump in and out of it. So you can see why it's necessary to also look at what's going on in the cash market. How would I view this? Well, I'm very confident that if the REIT indexes did not bottom this year, or won't bottom this year, they're going to bottom no later next year. I'm confident that we're going to see a good run up for 5, 7, 10 years or whatever in those indexes. Again, maybe those indexes will perform better than the actual real estate because of the stock market, because it is an investment vehicle and could get overly speculated. So you want to keep that in mind. But I think it's a good indication that at least this trend we're seeing here in U.S. national home prices is going to stay intact, and it's going higher. I think there's been considerable investment of people, especially the wealthy, pulling money out of the stock market, putting into real estate, they're putting into gold. There's an increased interest in Bitcoin. They're looking for something, at least on the hard asset, they're looking at the metals, real estate, that kind of thing, to store some money. And I think it's kind of distorting and supporting up, but basically providing support for the real estate, okay, the home prices. So that's also something to consider, but consider over time they may back out of that if they feel more comfortable with the economy and the stock market. They may not buy as much, but I'm not convinced they're actually going to sell them. I think maybe they look at it as a long-term investment. My thoughts are real estate is kind of high priced in this country. Rentals, I think, are outrageously high priced. I question how much gain we can get over the next 20 years, but there's a good chance the super cycles are up over the next 20 years. And what we just witnessed was a hiccup, apparently, for real estate, and not a sizable bear market. In the REITs, we certainly saw a bear market, but there again, not anything historical other than it was fast and it was short, okay, but not by a tremendous amount of percent change. So I think what this means is it was a correction within a super cycle trend. And I think now it's time for the next leg higher in a super cycle trend. But I also question how much we would get. I am a believer inflation's probably coming back in the next 20 years, but I don't believe it's going to be as robust as some people might think. It's going to come back somewhat. I'm not convinced. Does that speed up the increase in real estate? Because I keep thinking, well, how much can people afford to pay? And I'm rather hopeful inflation actually helps the middle class and poor and everything but their stock market and real estate, that they need to catch up for just better pay more money in their pockets and to spread around later in more investments. So don't know as I want to see a robust bull market, but frankly, I think that'll be just hurting people down the line. But maybe that's why we're going to get a super cycle top in late 2030s, early 2040s, when we could have a 1929 crash in real estate, stock market, and the economy. That's something else to talk about in the future. As always, check out criticalpointpodbean.com. Actually, it's criticalpoint.podbean.com. That's where I keep a list of the most recent podcasts, video and audio, mostly video. And I show charts, I show output, and give it an opportunity here. Become a premium service member, and you'll get some signals in some of these markets and a little more detailed information. Anyways, that's our update in real estate and NAREIT's possibility. We're seeing a long-term bottom here this year, and we can see at least a gradual increase going into the year 2027, perhaps later. As always, manage your risk relative to analysis of others. Thank you.